Welcome back, everyone. Now we're able to look at some charts, so we're gonna do just that. Just while we were off, you guys were speaking almost Chinese to me when you're talking about the VIX, or what is that? How do?
Well, the VIX an indicator of market sentiment and perceived risk and volatility. It's a volatility measurement, and it's traded in New York, and it's a measure by which it's a tool of forecasting risk in the market because it's a derivative, a market tool that people play to buy insurance on their equity portfolios. So when the VIX is low, that means that people are feeling pretty good and they're not feeling they need to buy insurance, and the price of insurance as measured by puts in the downside in the equity markets is relatively low. And alternatively, when markets are bad and investor sentiment goes highly negative, the VIX tends to rise because the volatility index also reflects recent volatility in the market. So the VIX currently at around 26 is at the highest level since March, and even only a few weeks ago it was down at 12. 12 is considered a very low level, and general bullishness in the market, which we saw in September, and now at 26, the highest since March. That's reflecting both the sell-offs and volatility in the stock market, but also the price of insurance that if people want to defend their downside on their portfolios using futures and options and other derivatives without selling those securities. Simply, it's the concept of buying financial insurance on your investment portfolio. The price of that insurance has gone way up. At some point, the VIX can be used as a contrarian indicator when bearish sentiment, the same way that one could argue that people maybe were too bullish in September now, in hindsight, and markets were running hard. That's when Amazon was the trillion-dollar company and the biggest market cap in the world, briefly. It's down over 20% since then. Amazing pullback. But when sentiment's strong, then we have a low valuation on the VIX, like 12. When sentiment's negative, we've had over a doubling in the VIX. And but in terms of contrarian indicator potential, once bearishness gets too high, that can often mean for certain market timers and market watchers that a very high level on the VIX means that everyone has turned so negative that it becomes time to buy. The hardest thing in the world is to buck the trend of the markets, and also to fight general consensus views on the marketplace, and obviously market consensus has been focused on the negatives the last few weeks.
Yeah. Okay. Well, that's good to know. So the VIX can be used as almost like, check it to get a general sentiment of what's going on. But if we could pull up the Dow Jones Industrial Average, that would be cool. There it comes. So we just talked about the VIX, but looking at what goes through your mind when you look at the Dow? Like, are you trying to get if you're comparing it not against a specific stock, but just sort of to get a sense of?
I mean, that's just a one-day chart, so that's a super short chart on the Dow. It shows that the market actually opened, it actually rallied a bit up to 25,000 this morning.
Yeah.
And that now it is rolled over, as we've seen so commonly in the, we're near the close, we're half hour to close. Market's now down a couple of percent on the day, I think, or maybe 1.5, but I think around 300 points. But and we tend to get the rallies are fading generally, where the end of the day, that traders who are trading during the day, they don't want to hold stocks over the weekend on a Friday. They don't want to hold them overnight because anything can happen. That is typical of bad markets, that traders maybe only active during the day, and they want to flatten out their positions because they're just not certain of where the sentiment may go. But in terms of leadership, because it's only 30 companies, it's often viewed as an overrated, but an over-focused upon indice of global stock markets, because it's only 30 of the biggest names of multinational corporations in the world. But it's certainly the most recognized index. The S&P 500 or NASDAQ or other indices around the world are much more reflective of what's going on in the broader stock market and where liquidity flows are going. But the Dow is the most often quoted. It's certainly a very old index. And it becomes a starting point for the snapshot. How's the market doing? It's going up today, it's going down. But as a flow of funds, it's certainly the key bellwether of U.S., if not global, stock market sentiment on a given day.
So is it fair to say that that's because it's kind of harder to move because the companies are so big? So if you were to see a big change, that would reflect a much bigger change more broadly?
I don't even think that. I just think because it was one of the first indices, if not the first, I'd have to look in the history books on that, and also because it's got the largest companies in the world in there. I think that as well does show the power of the Dow Jones Industrial Average, meaning that these are all massive multi-billion-dollar corporations. So it does reflect the flow of funds either into or out of stocks.
And when you look at it, if you just want to take a glance, do you look at you wouldn't look at the day, or what would you choose as a?
Well, I mean, people looking at a day chart would be looking again for sentiment on the day.
Yeah.
I think it's just one tool. Boeing, for instance, is down today a fair amount. But we had seen that Boeing was carrying the upside last week. That Boeing had a good day, and they had released strong results and announced some new projects, some new contracts. So it shows also that some of the biggest companies can have material influence, and when there's only 30 components, one can have a material influence on it. That's why it's often better to look at broader indices like S&P 500, which has the 500 of the biggest corporations, again, multi-billion-dollar entities in there, but 500 versus 30.
Okay. Well, I'm going to briefly take a look at the S&P, and then maybe we'll take a look at some commodity pricing.
Sure.
What for the S&P would you suggest as a decent way to look at it, like a month, 3 months, 6 months, 1 day?
I think a 6 month.
6 months.
Yeah, or even
pretty,
a 1 year.
Yeah, I mean, this is, to me, looks pretty demonstrative of the 6 month, because you just have a steady. If we can pull that up, I don't know if we can. But it's a steady incline upwards until you get a.
Well, it's looking very similar. This is a 6 month chart. We can see back at the very end of January, the other steep spike downwards just shows that almost like there's a buyer strike, which is meaning that buyers aren't interested in buying because they think they don't know where the bottom is on a short-term basis, and you have selling into a lack of buying, and you get these very steep drops. There's no joy in that. It's ironic that historic market watchers have used the term correction like it's the word correction meaning like it was something that needed to happen, or
Yeah.
it fixed something.
That's actually a year, just to point out. Sorry,
Oh, is that?
I was saying 6 months, but this one is a year.
Okay,
So you can see.
but it does take us back to the January period and into February.
Yeah.
It also shows, though, I mean, we don't see it yet. We don't know exactly where the bottom may come in, but there always is a bottom, even as chilly as things can feel. But you can see how rather rapidly the market turned around, and as we've spoken of before, money goes to cash. Cash yields are very low, even with the rising rates, so cash won't stay in cash that long because long-term institutional and individual retail investors, no one can meet their their longer term or even intermediate investment goals holding cash. Cash is about a preservation of capital. In the 1980s, you could get 5% on money market, which is a staggering historic number to think about, but that was 30 years ago when the whole interest rate complex was starting from or coming down from a much higher post-inflationary term. But you cannot meet your investment goals in cash these days. You could barely cover, if you're running 2% inflation, which typically most countries in the West try to run around 2% inflation, and that's another discussion for another day, but it keeps the economies growing, a little bit of inflation as opposed to the dangers of deflation. But if money markets are only yielding 1.5% to 2.5%, and there's tax payable at 30 to 50% in many Western countries, then holding cash is a preservation tool, but it will not help you earn your long-term investment goals. So money has to leave cash at some point. And the other thing I think, Fraser, that's interesting to keep in mind, that all investments are relative decisions. It's not always like, well, this asset class is a great buy, or this stock market's a better buy than this country's stock market, or bonds are a better buy than stocks on an absolute basis. It's about, on any given point in time, what's the best place for cash or to investment dollars to be focused upon. And it's one relative to another.
Yeah. I'm just trying to pull up, I'm not sure we're going to be able to get it up here, but the just because I mentioned we were going to do it, the commodity prices as well as gold price, we'll just briefly touch on that.
Well, we had seen gold have a big spike when it had spiked back up through $1,200 an ounce a few weeks ago, and we had one of the earlier sell-offs in the Dow, and there have been so many the last few weeks, they're almost kind of blurring together, sadly. But
this is kind of blurring together too.
Yeah. Now, just for the audience, what is the timeline you've pulled up on this chart?
It's, I believe it's 3 months. It's
3
happening.
months.
Yeah.
So we can see then that last big spike to on the upside to a new kind of plateau. In fact, the highest levels on that 3-month chart. That was considered maybe a significant turn in the valuation or a turn in the demand for gold, and thus the valuation for spot gold, and maybe a new technical platform. But gold, last I looked a while ago, it was down $7 on the day. Not a material move on a $1,200 $1,200 item, but the fact that sometimes gold is moving upwards when the stock market or the bond market's going down, and sometimes it's not. People try to read whether it's some kind of contrarian asset, if it's the beneficiary of some of that money leaving equity markets or leaving the bond markets. The more downside we get in stocks, and we're seeing the fear, or at least the concerns measured by the VIX we discussed, often that money can go to an asset like gold, but it can also go to an asset like bonds. And we've talked about how the concern about the strength in the U.S. economy and possible further rate hikes over the next year at the level of the Fed, and how that is affecting negatively bond yields. And we have rising bond yields, which means that bond capital values have been going down. But the offset is that the more negativity we get in the stock market is partly the market anticipating maybe the U.S. economy is not as strong next year as initially forecast, including by the Fed, and therefore bonds may represent an okay investment, and that becomes again the foundation for taking some of the negatives dissipating in the market, including in stocks. There's been fear that rates were going to go up a lot, and that maybe we've seen peak earnings. Maybe rates don't need to go up as much now as they did, which means that money could go to bonds again, which means that the rate profile, the interest rate hike profile is a little lower next year, and that's probably a better cushion to the real estate markets in the US and also to the stock market. So there are some kind of natural rebalance, I wouldn't say natural, but market force rebalancing going on about whether rates were going to go as high as people thought, which was negative for bonds and stocks. Now we're seeing some relief in the bond market, and it's almost self-fulfilling that if the stock market goes down as it has, that consumer spending psychology can be influenced and people feeling at one given time a little less optimistic, maybe arguably a little poorer than they were 2 weeks ago, because Americans in general, 60% of Americans have some exposure to the equity markets. In Canada, it's the opposite. It's about 40% of Canadians have exposure to the stock markets, and that may be direct playing in stocks. It may be through their pension plan or their RSP or through their mutual funds.
Mutual funds, yeah.
But the Americans have a much greater general exposure, so it's been good times for them for many, many years.
When you talked about the bond yield, is there a threshold there that when you see it you think like it is a decent investment to get into, or is it just all relative?
Well, it is a relative thing. I mean, bond yields need to be measured against obviously long-term expectation. You're talking 30-year bonds, 10-year bonds. I mean, how people can make forecasts over such long-term. I mean, most traders used to joke that if they're long-term investors if they own it overnight. But that said, a bond return should provide a real rate of return, that is inflation-adjusted return after adjusting for inflation and hopefully after adjusting for taxation. But that's not always the case about taxation. So the 3% level on the 10-year and on the 30-year have been considered major psychological thresholds, and certainly they're significant. They are significant, but that has to be in more recent years reflection or perspective, because in longer-term histories, bond yields on 30-year treasuries and 10-year treasuries were much higher than 3%. But certainly from the lows, I think the lows on the 10-year got below 2, and I think the lows on the 30-year got well down into the low 2s. So we're way up from there, and the big call as market watchers and players are trying to figure out is that the good times are over, the lowest yields, and I think many people feel that's the case.
Yeah, but as you said, it's impossible to predict long. I'm looking at 1981, 15.8%.
Well, it was a dark time. Most market watchers don't recall that or wouldn't know it, but I mean, you think of the damage that a 15% long-term bond does to, or any kind of rates over 10%. What it did was it sucked the money out of virtually every other asset class. There was no point in owning stocks. I mean, at that time, the 80-year return on the Dow Jones was approximately 10% a year. So if you could get 15 or 12 or 11 on long-term government securities, and your long-term expectation of return was only 10 on the stock market, yeah, and the stock market gives you much greater risk and much greater volatility, as we see now, and has always been the case, then there was no value and there was no logical reason as a prudent investor to have any money in stocks when you could exceed your long-term expectation of return buying a 10 or 30-year treasury guaranteed by the government in principal and interest, without accepting any of the equity risk. So rates that high took money out of Wayne Gretzky's rookie card and Picasso's paintings and real estate of every stripe and every stock market and equity market on the world, every collector market, and everything was wildly depressed. But that break in inflation and the eventual long-term decline in interest rates led to essentially a 30-year bull market in stocks and real estate and everything else. And even the movie Wall Street from 1988 or 87, whenever that came out, that kind of highlighted from a Hollywood perspective what was going on in the 1980s, the excitement in the stock market with the decline in interest rates.
Yeah, and that excitement came at, I guess today's 3% is yesterday's 7%, because if you look at between the years of, say, 1969 or so until pretty much 1997, most of the time it was above or hovering around 6%. So that's interesting. Yeah, I mean, why would you want to risk your money in the stock market when you can just get your 15 at that time? Yeah.
So what the challenge that came out of that was the long-term sustainable low interest rates, even where we are today, meant that the kind of, in some ways, wealth was transferring from investors to borrowers. It cost borrowers a lot of money through the 60s and 70s and 80s and even early 90s to borrow money corporately or for governments to borrow money when they had to pay the lenders. Essentially, the bond investors are the lenders. They had to pay them 6 or 7% coupons while inflation was running much lower. So what's called the real rate of return, the after inflation calculated real rate of return, meant that investors were getting well rewarded for buying bonds, and they were getting well rewarded for essentially loaning money to both government and corporate entities, any kind of borrower, including the banks were making money on that as well. But sustainably low interest rates have meant the opposite, and that meant that maybe investors haven't been getting adequate rates of return for the new risk they've assumed in bonds by loaning out money, by buying bonds, essentially loaning out money with a 3% yield, and they're only getting 3%, and inflation's running 1 or 2, and then the essential risk, like in the capital markets now, where a slight backup in rates means they can suffer significant capital losses on the bond side. So it meant that borrowing money's been a great place to be, whereas previously in those other years, borrowing money was not what meant you had to pay large to be a borrower, or more than maybe historically you had to pay. But the last dozen years of low interest rates meant that it was great to be a borrower, whether you're government running deficits, as so many of them do, sadly, or you're a corporation. And we talked about this previously, that a lot of the upside in the stock market has been based on borrowing money to buy back your own shares. And share buybacks means you're borrowing money cheaply, you're buying your own shares. When you contract your equity base in your company, that enhances your earnings, because your earnings are divided by a smaller denominator number of shares. You're adding leverage to your balance sheet, but you have strong cash flow, so you can service the debt, and you're borrowing money cheaply. That brings me to one other point, Fraser, and that is that during the earnings season that we're in right now, where companies are reporting, there are often blackouts for both insiders playing the market, both selling and buying stocks, and also corporations engaging in any of their own market-making activities of their own shares. A lot of these companies have previously announced and previously funded plans to buy more shares in the market of their own shares for cancellation, but they can't do that during the reporting period for Q3. So third quarter ended September 30th for most companies. The reporting period typically is through the month of October, sometimes a little bit into November. We've had a number of big high-profile reports coming out. Markets reacted in various ways, but one little ray of sunshine potentially is that when the blackout period comes off, that some companies, the ones with lots of cash that are well-funded, may view that this is a buying opportunity for the shares of their own companies which could provide an underpin and also a signal to investors of those individual companies when they see what's essentially insider buying when a company buys back its own shares once the blackout period restriction is off. That could be a positive.
Well, that sounds good. I think everyone would want to come from darkness back into the light. Stephen, thanks so much. I think we're going to leave it there today. And tomorrow, I just wanted to mention we're going to bring up the topic of small floats, which is a whole other ballgame when you're dealing with tremendous volatility. That makes it even more uppy-downy. So look forward to that, and just want to thank everyone for watching. And don't worry, James will be back soon. He's still in California for a couple more days, and then he'll be back in the driver's seat. So thanks for watching, and catch you next time.
Good day.